In the early 1970s, a number of German banks released Deutschmarks, the German currency, to the Herstatt Bank in exchange for dollar payments in New York. Between the time differences of Germany and New York, suddenly the Herstatt Bank went bankrupt, with the counterparty in New York receiving no money. Foreign exchange exposure was 3 times its capital of the Herstatt Bank. German banks started closing down, and banks outside Germany took heavy losses on their unsettled trades with Herstatt, adding an international dimension to the debacle. 3 months later, a group of men, the central bank governors from the G10 countries, US, United States, UK, United Kingdom, Belgium, Switzerland, Japan, Italy, and France, raised a few hard questions. Do banks know the capital that is required to sustain? Do banks know as to whom to give loans and how much? Do banks know the collections process? What if banks worldwide crumble? The committee established a banking regulations and supervisory practice. It was named as Basel Committee on Banking Supervision, BCBS. What is Basel? Basel is a city in Switzerland where the Bank for International Settlements, BIS, is based. The committee was formed from this location in response to the 1970s banking debacle. It is a group of international banking authorities who work to strengthen the regulation, supervision, and practices of banks and improve financial stability worldwide. However, the BIS and BCBS are 2 different entities. The committee's members now include many other countries, namely Argentina, Australia, Belgium, Brazil, Canada, China, France, Germany, Hong Kong SAR, India, Indonesia, Italy, Japan, Korea, Luxembourg, Mexico, the Netherlands, Russia, Saudi Arabia, Singapore, South Africa, Spain, Sweden, Switzerland, Turkey, the United Kingdom, and the United States. What is the purpose of BCBS? The Basel Committee formulates broad supervisory standards and guidelines for banks and recommends statements of best practice in banking supervision. The purpose of the accord is to ensure that financial institutions have enough capital on account to meet obligations and absorb unexpected losses. The BCBS does not have any formal authority, and its decisions are not backed by any legal force. The BCBS is organized under 4 subcommittees. The Standards Implementation Group, responsible for implementation. The Policy Development Group identifies and reviews emerging supervisory issues. The Accounting Task Force helps ensure that international accounting and auditing standards and practices promote risk management at banks. The Basel Consultative Group facilitates supervisory dialogue with non-member countries. In 1988, BCBS introduced capital measurement system called Basel Capital Accord, also called as Basel I. Basel I was enforced to strengthen the stability of international banking system and set up a fair and a consistent international banking system in order to decrease competitive inequality among international banks. The Basel I was based on certain principles. A bank should hold capital at least 8% of its total risk-weighted assets. For example, if a bank has risk-weighted assets of $100 million, it is required to maintain capital of at least $8 million. Banking capital was defined into two sectors: Tier 1 capital and Tier 2 capital. Tier 1 capital, core capital, 50%, equity capital, disclosed reserves. Tier 2 capital, supplementary capital, 50%, undisclosed reserves, revaluation reserves, general provisions. The Basel I also looked into risk, and its classification was derived as credit risk, market risk, and operational risk. Credit risk: risks associated with cash and gold held with bank, government bonds, etc. Market risk: associated with interest rate risk, foreign exchange risk, commodity price risk. Operational risk: transaction-related debt assets. It also went deeper into risk-weighted assets. According to the debtor category, a portfolio approach was taken to measure the risk, and the assets were classified into 4 buckets: 0%, 20%, 50%, and 100%. 0% risk weight: central bank and government debt, cash and cash equivalents. 20% risk weight: development bank debt or a public sector debt. 50% risk weight: residential mortgages. 100% risk weight: private sector debt.